Good morning, everyone. Chris here with the Groff team on location here on some single track south of the airport on the dirt bike. As you can see, as I strive not only to educate but to entertain here. So you can see it's definitely been plenty of a muddy morning. I want to touch base on a couple things here in the market. So right now we saw some stability brought in the market by the Fed coming out and making statements as to inflation being very tame. That's very positive, as inflation kills bonds, kills rates. So tame inflation and market indicators that there's not much inflation is good for our market. We're still seeing the effects of the Greek debacle, and what's going to go on there will continue to cause volatility in our market. And lastly, in reference to just what's going on and with the anticipation of rates going up, I want to talk to you about locking. Not trying to get fancy here with the change of angle, but after a 45-minute ride in the mud, you can tell my arms are shaking a little too much. So hopefully this is a little bit better as I wrap up here. We can, as far as locks go, we have locks as long as 6 months out. But typically what we advise is a 30 to 45-day lock. The longer you lock, the more expensive it is. And if we do extended locks in the 6-month category, that actually requires some locking fees be paid up front, and it's not refundable. So as we do go and literally reserve that bond and are on the hook for that. So basically what we advise, again, with in the vein of wanting to make sure that markets don't get better and we've paid more for a longer lock and just puts everyone in a bad situation, really try and keep it in that closer window. So keep that in mind as you have new contracts coming in, and also in new construction, want to make sure that you just give us a heads up when C of O is expected as early as 60 days out, so that we can start monitoring that market and make sure to get the best rate and terms possible for your clients. So